So come to this problem. This is one variety which is asked in the exam frequently, and this is going to be a combination of quite a few concepts. So along with solving this problem, the concepts also will understand. I mean, we would have discussed already, but revise the concepts. But along with the problem, we'll discuss it. So come to this problem. Hope you got the one. Okay, let's read the question. A Limited of India has imported some chemical worth US dollar 3,60,000 from one of the US suppliers. The amount is payable in 6 months' time. The relevant spot and forward rates are spot rate, 6 months forward rate. The borrowing rates in India and US are 9% and 6% respectively, and the deposit rates are 7.5 and 4.5 respectively. Currency options are available under which one option contract is for US dollar 1,000. The option premium at a strike price of 70.05, rupees 5 call option, rupees 4 put option. The company has three choices: forward cover, money market cover, currency option. Which of the alternative is preferable? When they give you the question like this, don't tick one of them. It's not a multiple choice question. You have to discuss under all three scenarios how much will be your cost, or in this case, importer. Okay. So what is the specialty of this problem? We are talking about an importer position. Of course, Indian point of view, they have given the rates, they have choices. Forward cover, we know that is forward hedging. We have discussed the concept of forward hedging. Money market cover, money market hedging, that concept also we discussed. Currency options. So in this case, one new thing is coming, which is option hedging. So here we're also going to discuss about how options were to be used as hedging purpose. So your concept of derivatives options also should get revised here. I don't know to what extent I can rely on you. Of course, I'll try to revise a little bit, but at least you should know basic concepts. I cannot repeat everything from beginning, everything from scratch. Let's see to what extent I can make you understand. Okay, for the simple thing, we'll start with the easier things which you should know by now. One is forward cover. Now, importer, forward cover, he should go for forward buy. Why? He has to make a payment to his supplier. He needs US dollar. He will purchase from the market. Simple enough. He will go for the forward rate. And which rate is applicable in the forward rates? Since you are buying customer at a disadvantage position, you will buy at a higher rate, 69.95. Now, if it is money market cover, what we should do? You remember the shortcut we learnt? Use the IRPT formula to get the strategies, then make the 3 steps to present the answer. Let's follow those 2 first. Let's understand it clearly, and then we'll come to currency option. Let's see what would happen. Okay. Okay, so first let's say forward cover, forward hedging. Forward cover, forward hedging. 3,60,000 US dollar. So forward buy for an importer. Forward buy for importer. Uh, 3,60,000 US dollars multiplied by 69.95. 2 crore 51 lakh 82,000 rupees. That was dollars. So rupees 2 crore 51 lakh 82,000. Okay. This was very simple. And this one importer. So this is outflow. Cash payment outflow rupees. For importer, he has to make a payment to get the dollar. And the dollar he makes the payment to his supplier. Now money market cover. That means money market hedging. Hope you remember the shortcut. But don't write the answer in the shortcut. You should give the steps. What is the shortcut? Use IRPT formula. For an importer, it's going to be invoice amount multiplied by spot buy rate or sell rate. It's going to be spot buy rate for importer, spot buy multiplied by 1 plus local divided by 1 plus foreign. And local which one? Because importer is having a liability, the numerator is going to be borrowing, denominator is going to be opposite, that is 1 plus foreign deposit. In this case, local borrowing means rupees. In this case, foreign deposit means dollars. Okay, let's write this in a stepwise manner. Step 1. Hope remember, you write denominator first, then you go to left side, then go to right side. Hope remember the root to remember. First step, then come left side, second step, then go top, third step. So first step, present value of foreign deposit. You don't have to remember too much. Whatever is there as the line item in the shortcut, that you give as heading. 1 plus foreign deposit is there. Don't write 1 plus present deposit. Present value of foreign deposit. So invoice amount is $360,000 divided by foreign deposit, dollar deposit. The deposit rates for dollar is 4.5, second number 4.5, 1 plus 0.045 and multiplied by. This is only for 6 months. Remember, they give critical information in words, not in numbers, so that you miss out an exam. Read these things carefully, or whenever you read some, make a small mark. Into 6 by 12, 6 months time. $360,000, 3,52,078 is it dollars? 3,52,078. Right? Okay. Second step, step 2. Step 2. Is what? The step 2 here, spot buy. So purchase the above in spot market. Spot buy to be specific. So dollar 3,52,078 multiplied by we need the spot rate, and because we are buying at a higher rate, spot buy between these two, the higher rate 68.2. rupees 68.2. So we get 2 crore 40 lakh 11,720. Okay. This is not, sorry, not in dollar, this is rupees. Once we apply conversion rate, we get rupees. 68.2 is conversion rate. We apply rupees. Step 3, borrow the amount as above and repay. Borrow rupees required for above for step 2 and repay. So how much you need to borrow? We just calculated rupees 2 crore 40 lakhs 11,720 multiplied by Indian borrowing rates. The borrowing rates in India is 9%. Don't take US 9%, respectively, give respect. India is 9%, US is 6%. So borrowing rate in India, 9%. So 1 plus 0.09 into 6 by 12. Two crore 50 lakh 92,247. So here we have 2 crore 82 and here we have 2 crore 50. So because of the decimals, some round off can be different, but approximately this is the one. Okay, hope you got this one. This should not be confusing because this was already discussed earlier. Hope this is simple enough. Okay. So this what we discussed now is with respect to the forward hedging and money market hedging. Now we'll come to the main area, which is options cover, options hedging. So along with this problem, we'll understand this concept, option hedging, option hedging. Okay. So what are the things to be decided here in option hedging? First of all, you should decide whether we should go for a call option or we should go for a put option. That's first thing. And then we should decide the number of contracts to be entered into, and then ultimately the cash flows that are happening in options. So three broad steps. Step one, we should identify the type of option. I'll give you the few steps to identify which type of option is applicable. If you're comfortable, you can directly write one line. Otherwise, I'll show you the steps. Okay, step one, type of option. Step two, number of contracts. Why number of contracts are essential in options? Because you will always have a lot size. So that is the reason. Third step, step three, is cash flows. For cash flow, you need more space. That's only last step anyway. Cash flows in hedging. Cash flows in option hedging. Cash flows in options. Okay. Type of option. You know, two types of options are there. Call option, put option. Call option means the holder will pay premium and get the right to buy the underlying asset. The call option writer, C minus, call option writer will receive the premium and he assumes the obligation to sell the underlying asset at a strike price. So call option holder gets the right to buy the underlying asset. Call option writer assumes the obligation to sell the underlying asset. Whereas put option holder will pay premium, and what right he gets? Put option holder P plus pay the amount of premium to get the right to sell the underlying asset at a strike price at a later date. Whereas put option writer P minus will receive the option premium and assumes the obligation. What is the corresponding obligation? Holder has got the right to sell. So put option writer will assumes the obligation to buy the underlying asset at a strike price. So holder always receives the pay premium, writer always receives the premium, and holder always make a decision. So if your decision, or if you want to have a decision of buying, whether to buy or not decision of buy or sell, decision of buy or not, that is call option, holder position. Whether to sell or not, if you want to have that right, it is put option. Hope that is clear. Okay. Now, when we talk about option hedging, we only think from holder point of view. We don't think from writer point of view. We only think from holder because writer assumes obligation. So we don't want to have an obligation here in the options. We want to have a clarity. We are doing hedging. We are trying to make sure our cash flow is certain. So we will become a holder position with respect to this foreign currency option hedging. One beautiful thing about the currency option. What is currency options? What is share options? Underlying asset is shares. What is index options? Underlying asset is index. So based on whatever underlying asset which is agreed to be purchased or sold on expiry date, that is the type of hedging, the underlying asset. In this case, the underlying is currency. So currency is what is being exchanged. But one beautiful point about the uh, currency option is this. Suppose underlying asset is pounds. Underlying asset is pounds. And you pay dollars. So dollars you pay, underlying asset pounds you get. Is it call or put option? You have the right to get pounds and the right to give dollars. Understanding? Right to get pounds and right to give dollars. So every currency option, every call option is also a put option on the other currency. Like on dollars, if I say I'm purchasing, pounds I'm selling. Or pounds I'm purchasing, dollars I'm selling, because both are two currencies, both are two products. So every call option on one currency is implied put option on another currency and vice versa. But so much we don't have to think. I told you, so you are aware of it. For solving problems, we don't have to think like that. You just be aware of it, sufficient. Okay. For solving problem, what we need? Do we need call option, put option? That's all we require. I'll tell you the steps. First, you identify what is the underlying asset. Whatever the quote is there, you write down. First, you write the quote. Whatever the strike rate, quote. In this problem, what is the quote given? uh, Option premium at strike price of 70.0505. Okay, call option premium 4 rupees, put option premium 4 rupees. So that is later. But strike price 70.05. Code. So strike price $1 equals 70.05. First you write that. Then you identify the underlying assets. Identify the underlying asset. UA, again, don't think some movie rating, underlying asset. Now, underlying asset can be understood in two ways. In any way you can identify, because this is an important step. Because the classification of call option or put option depends on the underlying asset, the currency which we are going to identify. Now, in this contract, they said one contract is for US dollar 1,000. Can you please tell me what is that? One option contract is for US dollar thousands. What is 1,000 there? Are you able to identify what is a 1,000? One option contract is for US dollar thousands. Lot size, that's all, simple. Lot size, correct. Lot size. So now when I say lot size 1,000, that is the underlying currency. So whenever I mention something lot size 100 shares, lot size 20 index points, lot size 1,000 quantity of rice, whatever the lot size we mention, that is the underlying asset. So here we say lot size was underlying asset is dollars, US dollars, because lot size is under USD, is in USD terms. Lot size in USD terms. So whichever lot size in whichever currency is in lot size, that becomes underlying asset. In some problem, underlying asset is not given. Okay, in that case, in the quotation, what we have now, the left hand side currency in the strike rate, in the quotation. What is the left hand side currency? In this case, in quotation, strike price $1, 70.05. That will be your underlying asset. So preferably go with lot size. If lot size not available, in the quotation, you go $1 equals to, that will give you. Okay, now movement of a requirement with respect to underlying asset. Requirement, and remember, requirement with respect to underlying asset. With respect to underlying asset. Okay, now think from the underlying asset. What is underlying asset here? USD. Now, USD is the customer need to purchase in the options or need to sell in the options? You are thinking from an importer point of view. You are thinking from an importer point of view. Importer has to make the payment to the foreign supplier in dollar terms after some time. He needs that US dollars from US dollar terms, only from US dollar terms. Why US dollar terms? Not because invoice, but because the underlying asset. That's why it is, you need to buy in the options so that he can give it to the supplier. Therefore, it is to be buy USD. By USD within brackets underlying assets. Underlying asset. Suppose, just a question. Suppose in this case, if lot size was rupees, then what would have happened? Imagine and tell me. If lot size was rupees, what you would have done? If the lot size was rupees, the USD you need, but I don't want to think from USD point of view. If the lot size was rupees you would have given, you would have paid to get dollars because we wanted dollars, but underlying asset is rupees. So with respect to rupee, we are giving. So it would have been put option on rupee, underlying asset. So write one note. No writer, no put option writer position. I'm sorry. I made my point very clear. Writer position will not come in our discussion in option hedging in currency chapter, foreign currency management. We don't talk about writers. We only talk about holders. So write down. If the underlying asset was rupees, just a note somewhere, it's not relevant for this problem. I'm just preparing you for other problems. If the underlying asset was rupees, if the underlying asset was rupees, if the underlying asset was rupees, then also importer needs USD. Importer needs USD. Importer needs USD. But from rupee point of view, it will be an outflow. From rupee point of view, it will be an outflow. It will be an outflow. Within brackets, sales. It will be an outflow. Within brackets, sales. Sales. Hence, put option holder position. Put option holder position. Put option holder position. Put option holder position would be applicable then. Put option holder position would be applicable then, not in this problem. I am discussing a scenario here, mind it. Please make a note of that very clearly. Put option holder position applicable then in that scenario. But here, what is the type of option? Because we have to buy underlying asset with respect to USD, only underlying asset we are buying. Therefore, it is going to be call option. Call option. Call option. Hope that is clear. You should always think from the underlying asset point of view. Being an importer or maybe a position of exporter, do I need that currency or am I giving that currency? Is that currency come to me or that currency should go out during hedging? One currency will come in, other currency will go out. But with respect to that underlying asset given in the problem, we have to make a decision, either call or put. There's one small shortcut. What you should do is this. Small shortcut. Look at underlying assets and look at invoice amounts. If they are same, then you do regular process. If they're opposite, basically it's a indirect quotes. Then, if they're not same, if they're not same, then do reverse, do opposite. What do you mean by this? In this problem, what is the invoice amount? Dollar. What is the underlying asset? Dollars. Both are same. Do regular stuff. What do you mean by regular stuff? Call option is used for buying purposes. Put option holder position is for selling purpose. That is the basic you should know. Call option holder position is for buying purposes. Put option holder position is for selling purposes. Regular thing, do regular. That is, in this case, you are buying. So regular thing is call option. Regular means call means buy. Put means sell. Regular thing. Regular thing. But if underlying asset is different from the invoice amount, what do you mean by that? An example I gave you, rupee is the underlying asset. Opposite. Invoice amount is invoice amount is dollars. US dollars. But underlying asset in rupees, not in same terms, not same. So do opposite. What do you mean by opposite? If you want to buy, that is call option used for sell, and put option you use it for buy. In this case, what you're doing with respect to US dollars? Importer wants to buy, do opposite here, not call, you go for put. Either remember the shortcut or remember the regular method. Don't remember both. Either the shortcut method or the regular method. Don't try to remember both initially. Don't mix the concepts. Either we only think from the invoice amount point of view, or we only think from the underlying asset point of view. Stick to one. I'm sure you get the answers. I'll give you 1 minute. Tell me if you have any doubts. For opposite case, we have written a note also. Which one you want me to explain in the opposite case? In the shortcut method or regular method? Okay. The shortcut method is this. Shortcut method, regular thing what you should do is, regularly call option is for buying, put option is for selling. If it is opposite, you should do reverse. When is it opposite? When the underlying asset and the invoice amounts are different. In this example, underlying asset is in, let's say, rupees, but invoice is in dollars. Opposite, not same. So your decision also should be opposite. Normally, an importer would have gone for buying, means call option. Now here, he should go for put option. Normally, an importer is a buyer. He would have gone for call option. Now, we are doing in this problem, you are going for call option. But if it is opposite, that is underlying asset is different, invoice amount is different, do reverse your position. Don't go for call option being an importer, go for put option being an importer, opposite position. Normally we take call option. Normally buying is for importer, normally is call option, but don't do call, go for put if invoice amount and the underlying assets are in different currencies. Is it fine? Okay, I'll go further. I'll just write this chart once more. I know it will be repetition, but I'll just write the chart once more, the shortcut chart what we just discussed from an importer point of view, exporter point of view. So it will act as a one place ready reference. I'll just write it in a separate page. Okay. So type of option, how to decide type of option. Two scenarios possible. The invoice currency and underlying assets, underlying currency are same. Regular stuff. If they are same, an exporter will go for put option. Importer goes for call option. Invoice currency, this is second situation. Invoice currency and underlying assets currency are different. Like invoice is in dollars, but underlying asset in rupees. An exporter, importer. Normally an export would have gone for call or put option. Now you go for call. Importer normally would have gone for call option. Here you go for opposite put option. This is a shortcut. This is not logical. Logical, think from underlying asset point of view. If underlying asset is coming in, then it is call option. If underlying asset has to go out, put option. Okay. Hope it is clarified. Are you clear on this one? Okay. Okay. Let's come to number of contract now. Number of contracts. Number of contracts formula is very simple. Very simple one. Invoice amounts divided by lot size. Invoice amount, in this case, $360,000, and lot size is $1,000. So you get 360 contracts. 360 contracts. Now, here you please tell me. Here we got the exact 360 contracts, no decimals. But in some problem, decimal can come. Correct? 360.12 and all. In that case, how do you manage the decimal point? Normally, for the decimal thing is there. No. For that, we take a forward cover. That small fraction, which is not covered by option, we will take a forward cover. We don't go for future. I think you still have confused between future forwards. Forwards are different, futures are different. At least in currency chapter. Future hedging we are yet to learn. Only use the word forwards because forwards are the contracts. We only talking about contracts. Why you have to write currency sign before or after amount? Getting confusion. We have to write the currency sign, otherwise you will not get clarity. You should not get confusion. That's why I'm writing the currency. I mean, before or after does not matter. That is left to you. You can write before or after. That does not matter. Come on. Is that the question you're asking at this level? Whether you write the before currency, after currency, that does not matter. Rupees 70 or 70 rupees. What difference does it make? I think next time you'll ask the question, should I write it in red ink or blue ink? I'm getting confusion. Come on, please don't ask such questions. Before or after, you write wherever you want. Or you don't write, that's your left to your choice. Okay, so invoice amount is $360,000. Lot size $1,000, so 360 contracts. So if there's a lot size, for the decimal fraction, we will do forward cover. I'll be doing that kind of problem also. So that is one challenging we have to face. One more challenge that you have to face is this. One more challenge you have to face is this. If invoice amount is different and under a lot size is different, in the sense, example I gave you, invoice amount is in dollars, but lot size in rupees. Then how do we tackle this? Then you should convert the invoice amount into underlying terms. How do you convert? You can just mention somewhere. If invoice currency is different, if invoice currency is different, then the formula is going to be invoice amount is correct, but you have to divide it by strike price, then divide by lot size. If the invoice currency is different, invoice amount divided by strike price. Why? Because invoice amount is in different currency, lot size in different currency. Invoice amount to be converted into lot size in underlying asset terms. And how do we convert? For conversion rate we require, conversion rate is the strike rate. So divide the strike price. So divide by strike price, the invoice amount will get converted into the underlying terms, and then you can do lot size. That problem also will be doing, there you get more clarity. Anyway, now what are the cash flows in options? Broadly, there are two cash flows. One is strike price on expiry. And second, premium today, premium at inception. And third one, this is slightly controversial, I would say, interest on premium. I would say this is discretionary. Because institute does not take sometimes and they take it sometimes. Both are logical. They don't take it sometimes because options, what do you do? Today you pay premium, on strike price, on expiry you pay strike price. Difference you call it as your intrinsic value, then pay off. So interest on premium is not really considered. But one more logic, premium is paid today, whereas the strike price is paid later. So time value of money is there, so we should consider it. In my opinion, that should be considered, interest on premium, but you can write a note in the exam whether to consider or not to consider. Okay, strike price, and one more, forward cover for fraction, if any. Forward cover for fraction. Fractional contracts, like number of contracts round off I told you, then in that case that will be applicable. Okay, so strike price on expiry, premium at inception, interest on premium, forward cover for fraction. Strike price expiry, how much? $70.05, 70.05 into, don't multiply it by invoice amount because of round off can be there. So what do? Multiply it by number of contracts and lot size. Number of contracts and lot size. Number of contract is 360, lot size is thousands. So it happened to be 3,60,000, but not always. When there are rounding off will happen. So equals 2,52,18,000 rupees. 2,52,18,000. Now one more question. Please tell me, will this be paid? I mean, will this be excess? Will this amount be paid always? Strike price, is it compulsory? It will be exercised? No. This is the worst case scenario. So this will be exercised if market price not beneficial. So options, depending on the what happens in the market, you'll always have a choice. But anyway, so this one is if exercised, and we don't know whether we exercise it or not. That will come to only later. But as of today, this is our maximum outflow. So if exercised, premium at inception, same. Premium is how much? For call option premium, we selected call option. Call option premium 5 rupees. So rupee 5 multiplied by same process, multiplied by number of contracts and the lot size. Number of contracts, lot size. Just like the strike price, same process. Number of contracts and lot size. So 5 into 360 into 1000. 18 lakh. Interest on premium, I told you it's discretionary. If you want, you can take, or if you want, you don't take. You either case write a note that interest on premium also considered or not considered, whatever it is. Make a note in the exam. Institute sometimes take, sometimes not take, but mostly they don't take it. But anyway, 18 lakh into the rupee terms, so rupee borrowing terms. Rupee borrowing is 9% into 6 by 12. 81,000. And forward fraction, nothing here. So what is the total of all these three amounts? 2,52,18,000 plus 18 lakh plus 81,000. 2,70,99,000. So previously it was 2,51,00,000, 2,50,00,000, and here it will be 2,70,00,000. So which is recommended? You can just say, I think money market hedging is cheapest for importer. You can say money market hedging is beneficial. Money market hedging is beneficial. Money market hedging is beneficial. Okay, hope it is done. Okay, I'll go further then. Okay, so let's do this problem now. XYZ Limited, a US firm, will need 3 lakh pounds in 180 days. In this connection, the following information is available. Spot rate 1 pounds, 180-day forward rate, interest rates. A call option that expires in 180 days has exercise price of $1.97 and a premium of 0.04. XYZ Limited has forecasted the following spot rates as below. Future rate, probability. Which of the following strategies would be most preferable to XYZ Limited? A forward contract, a money market hedge, option contract, or no hedge? Show calculation in each case. Again, since 4 options were there, they were wondering what if you tick one option like a multiple choice question. SFM, no multiple choice questions. You have to give detailed workings. One interesting point in this case. Second. Okay. This 4.5%, 5%, 5%, 5.5%. In the question, I have added not annualized. So you are going to use 4.5 directly, 5% directly. But institute had not given this in examination. So normally what we would interpret 5% per annum, 5% per annum, 5% per annum, 5.5% per annum. Then for 6 months, 180 days means we will do into 6 by 12. But somehow the institute has not taken this per annum, they have taken directly 6 months only. They have not done 6 by 12. So I have no comments to say. All I can say is whichever way you interpret, make a note in the examination. Make your assumption clear. You can assume this way, you can assume that way. Institute has followed different approaches. Normally, I would recommend when they tell you percentage in a simple manner, take it as percentage per annum. And for whatever the period, multiplied by 6 by 12, 3 by 12, whatever it is. Okay, in this problem, I have modified the question, so no problem here. We take 4.5 directly, 5% directly. If they're not given, you interpret 4.5% per annum. Then for the month, you multiply it by whatever the term. But even if you assume otherwise, it's equally fine. But make a note. My recommendation, if the percentage is given and not given analyzed like this, then you take the percentage as it is. If they're not given like this, then take percentage as per annum basis. That's my recommendation. Anyway, so we are having forward contract, money market hedge, option contract, no hedging. Oh, this situation is also there because we know they have forecasted what could happen, future rates on the, forward rates on the expiry date, what could happen. So we can know expected amount based on probability, expected amount, expected spot rate. Okay, so let's do 4 options. First is forward contract. Okay, so forward contract, you're talking about a person who need 3 lakh pounds, who needs this. So this is again a position of importers who needs pounds, because you're talking about US firm. A US firm needs, a US firm needs pounds, therefore it's like a position of a importer. 3 lakh pounds. Okay. Uh, okay. Pounds, and what we have is 1 pound is so much dollars. So left hand side only one rate. Oh, no higher rate over it. Only one rate is available. So directly we'll do. So 3 lakh pounds was there, multiplied by the conversion rate, that is spot rate. We need forward rate. Forward rate is 1.96 pounds. Left hand side multiply. Since pounds, applying conversion rate, we get the answer in dollars. Five lakh 88,000. Then market cover, uh, formula will write first. Invoice amounts into spots, buy for importer, spot buy 1 plus local. For importer it's going to be borrowing first, and divided by 1 plus foreign deposit. So local means dollars, because US firm, not a UK firm, US firm, and foreign means pounds. Local is deposits, deposit borrowing, dollar, so local dollar borrowing, and foreign in this case pounds, because US firm. So invoice amounts 3 lakh multiplied by spot buy. Only one rate is there, that is 2. This is invoice amount of pounds multiplied by 2. Okay, no, we don't do directly. We'll write in steps. We don't want to do directly. Let's do it in steps. Step 1, present value of foreign deposit, which is equal to 3 lakh pounds divided by 1 plus foreign deposits, that is pounds deposit. Pounds means UK, deposit rate means 4.5, 0.045. Again, since I've given not annualized, I'm writing as it is. Alternatively, you can do into 6 by 12. 3 lakh divided by 1.045. 287,081 pounds. Step 2, spot buy. Buy the above in spot buy. Buy the above in spot market. Two 87081 into spot buy. Multiply, because left hand side is the pounds and we have pounds only. Multiplied by spot rate is 2. So 287,081 into 2, 562,162. So this will be in dollars now, because once you apply the rate, dollars you get. Step 3, 574. Okay, 574162. 574162. Step 3, borrow the amount above and repay. So 574162 multiplied by 1 plus borrow US dollar borrowing rate 5.5%. 0.055. 605741. 605741. Dollar 605741. Okay, so effective outflow was this is for Indian import. Okay, effective outflow under forward hedging 5,88,000, under money market hedging 605741. Okay, and what we have to do now is with respect to the option hedging. Okay, let's go further. Option cover, option hedging. 3 steps. Step 1, type of option applicable. In this problem, only one given, but still, as a step we'll write. Step 2, number of contracts. I think in this problem, we don't have much. Step 3, cash flows. Okay, types of option. Type of option, start from the quotation given. Quote given, one strike rate. What is strike rate? Exercise price of 1.97. So 1 pound is $1.97. So what is the underlying asset? A lot size have they given? No lot size. So lot size not given. So we will take this left hand side as pounds. That is pound becomes underlying asset because left hand side currency in quotation. The strike rate quotation given. Then requirements. You need pounds, meaning buying pounds. You need pounds, buying pounds. Therefore, type of the option is going to be call option. And shortcut also I told you, it is the importer position. Look at the invoice amount is in pounds. Look at the underlying asset is in pounds. Since both are in pounds, same currency, what would a regular importer would do for buying? He would have gone for call option. Now also you go for call option. That's the straightforward thing. Okay, number of contracts don't apply because no lot size given. So invoice amount itself, let's say 1 contract equals to how much are required? That is 3 lakh pounds. We don't have information about the lot size, so we'll say one contract. One contract, so will cover everything. Cash flows. Cash flows. Okay, cash flows. Four kinds broadly: on expiry, strike price. I'll leave some more space for this because we need to discuss few things. Then we can do premium today. Premium at inception. Interest on premium, discretionary. Mostly institute has not taken interest on premium. And forward fraction. Forward contract for fraction. That will not come here because number of contracts is one only. Forward for fraction. Forward for fraction. Okay, now strike price on expiry. This is a interesting point here in this problem because we know strike price is 1 pounds is equal to $1.97. And in the earlier problem, what we used to assume? We used to assume that the option is exercised, isn't it? We used to assume that option is exercised because we don't have any information about the market price. But in this problem, the expected forward rate, expected rate on expiry date. On expiry date, what and all could happen along with the probability they have given. So when you know what could happen, based on that, you should take a judgment whether to exercise or not to exercise. Correct? Because normally we used to assume in the option hedging, strike price is exercised, the amount is paid or received. But here it's not the case. We have expected price. So we should know, okay, don't take strike price blindly. Take the strike price, then compare the expected spot price, then choose will the option be exercised or option not exercised. Okay, so strike price is 1 pound equals $1.97. What is the expected market price becomes? Let's do what and all is there. Future rate, that is expected spot price on expiry. That's what I said, future rate. Expected spot price on expiry. 1.91, 1.95 or 2.05. 1.91, 1.95, 2.05. And all these things we are settling on delivery basis, okay? I'm not going for net basis discussion. Everything delivery basis. So spot price on expiry, 1.91, 1.95, 2.05. And probability. %, 60%, 15%, 0.25, 0.6, 0.15. 0.25, 0.16, 0.25, 0.60, 0.15. 0.60, 0.15. Now, how do we do the expected value? Multiply the product. So 1.91 into 0.25, 0.4775, 1.95 into 0.6, 1.17, 2.05 into 0.15, 0.3075. So what is the expected spot rate? 1.955. Okay, so we are talking about call option. Here 1.97 is the strike price. 1.955 is the market price, expected market price. Now, is the option exercised or not? Back to basics. Call option is exercised when the market price is high, because call option would gives you the option right to buy. You would like to buy at a lower price. When the market price is high, market is not beneficial, option is giving you cheaper price. The strike price is cheaper. You would like to buy at a strike price. So 1.97 strike price, market price 1.955. So do you think strike price would be beneficial or the market price would be beneficial? Call option, where would you like to buy the pounds? Of course, you buy the pounds at a cheaper price. In the market, available at 1.955. In the option, available at 1.97. So we would like to buy in the market, which means the option don't get exercised. It will lapse. It will lapse. And if you do exercise, if you do solve the problem like this, call option, market price is less, so will lapse. Yes, market price is 1.955, option will lapse. And if you think like this, your marks also will lapse. I told you earlier, when this probability came in options, I showed you this calculation and also told you don't do this mistake again later. When option comes, we don't calculate expected market price like this. We should calculate at each situation, will you exercise or not. Remember, expected intrinsic value problem we have told, and there I showed you what is the meaning of showing like this, and that is not right. You have to calculate individually whether the option is exercised or not, and based on that you should calculate the expected price, not like this. This is the common mistake. We should not do it. I told you earlier, and that time also, please refer earlier problem. There also I've written and I've cancelled it to show you should not have done like this. And also I told you there, you will do mistake like this. We have done. Anyway, fine. Let's do the right thing then. So what you should do, what is the expect cash flow on expiry? You should calculate one by one separately, cash flow on expiry. I'm not doing settlement on net basis. If I'm doing settlement on net basis, I'll do intrinsic value calculation, then market price, overall I get the answer. But net amount I'm not going, delivery basis, because you need this, you need the pounds. So cash flow on delivery basis, so cash flow on expiry. So what is the correct thing to do? You should not do overall decision. You should do at each price, what is your decision? What will be your purchase price? Now each price, market price 1.91. Strike price 1.97 at each situation. Okay, 1.91 market price is less. So where would you like to buy? Not in the option, in the market itself. Therefore 1.91. I'll put one star here, which basically means option lapse. Call option not exercised in market price is less. Option is not utilized. So for intrinsic value, would have taken 0. But I'm calculating the actual cash flow. I'm not buying in the option. I'm buying from the market. Now, second case, 1.95. Still lower than the strike price. Still cheaper than the strike price. Available in the market at a cheaper rate. Go to market. Buy at 1.95. Again, same star. Option lapses. If it is intrinsic value, would have taken 0. I'm solving settlement on delivery basis. I need the amount to be purchased. So 1.95, I'll go to market and buy cheaper at market. 2.05 market price. Here, market price is more. When market price is more, option becomes more cheaper to buy. So you'll buy at a strike price 1.97. So at this price, option is exercised. Market price is high. Call option exercised. Why? Because market is costlier. Option is cheaper. Cheaper to buy in the option than market. Then you multiply by the probability. You get the product. Then you may ask, so even after knowing this 1.95 was wrong, why have you done like that? Why did you do that mistake? You could have told the right thing. You could have saved some time. This will be used later. I would like to show that calculation, so I've shown it. I'll be using it later. How? I'll come to it in some time. Okay, let's do the product. Probability into cash flow, 0.925 into 1.91, 0.25 into 1.91, 0.4775. Oh, this one number is same only. Second also same only, 1.95 into 0.6, 1.17. Third one will change. Because in third one, market price is high, option exercised. 0.15 into 1.97, 0.2955. Plus 1.17 into 0.4775, 0.4775 plus 1.17 plus 0.2955, 1.943. So what is this 1.943? 1 pound equals $1.943. This is for 1 pound. And there is no lot size here, one contract. Lot size, entire invoice amount, 3 lakh into 3 lakh. 3 lakh pounds. So how much do you get? 1.943 into 3 lakh. 5 lakh 8,900. And which currency it will be? Because 3 lakh was pounds, we applied the conversion rate, we get the other currency, which is dollars. 5 lakh 8,900. Okay. So this is about the strike price on expiry. Premium at inception, that is very clear. Again, premium amount, there is no confusion there. Premium amount, 0.04. 0.04 into lot size, one contract only, into 3 lakh pounds. 3 lakh pounds. So 3 lakh into 0.4, 0.04, 12,000. And dollars or pounds. 3 lakh pounds. We applied premium. Both strike price and premium are like conversion rates. So when you apply the premium, the resulting will be another currency. Therefore, here you get $12,000. And should I convert this into pounds again? Not required. The person is from the US firm. US firm point of view. So we are keeping the answer in dollar terms. If the question is from UK person point of view, then this dollar would have been converted into pounds terms. But anyway, this is in US firm point of view. So dollar is there, keep it as it is. Interest on premium, discretionary. Mostly institute don't take it, but you can take, but I would take normally. So $12,000 multiplied by the rate of interest. Dollar borrowing. Dollar borrowing 5.5%. $660. There is no fraction, nothing, zero. The total, $5,95,560. Dollars. There is one more they've asked. This is third one. One more they've asked. Fourth one. Unhedged situation. Unhedged receipts. Unhedged payment. No hedging. Unhedged. No hedging. Unhedged means what? You don't go to forward market, you don't go to money market, you don't go to option market. Where else you go? You go to market. You go to spot market. And in spot market, there were three possibilities with three probabilities. So expected value, which we already calculated. So we will take 1.955. That's why I calculated that. I know that was not useful in that situation, because all the things may not be exercised. But when you are going for unhedged situation, you have to do in the spot market. Three situations are there, probability is there, you should multiply and get the expected cash flow. So get the amount directly. That number I'll use 1.955 into 3 lakh pounds. Five lakh 86,500. Okay. So 5 lakh 95 600 5 lakh 95 560 in the option hedging, 5 lakh 86,500 in unhedging, and here 5 lakh 88, 6 lakh 5. So comparatively, which outflow is cheap? Unhedged situation is beneficial. So we can just write based on the expectation, unhedged position is beneficial. Unhedged position is beneficial. Unhedged position is beneficial. It's risky only, but comparatively, because they're asking among the four which is most advantageous, we are recommending most advantageous. Comparatively, which is most advantageous, because question is asking about it, most advantageous. Okay, let's go further. Okay. Okay. So let's do this problem now. So we have discussed about option hedging. This problem will cover future hedging. Again, you can see this variety asked so many times in exams. And when they ask so many times in exam, what does it mean? That will tell you the performance of students in exams. Many students do performing well in class because somebody else will be doing. Exam, you have to perform yourself. And this is one question where usually student struggles. But if you understand option hedging, it's very similar. In fact, much more easier. Anyway, so let's understand future hedging based on this problem. Hope you got the question. Similar questions are there like this, many things. So make sure you come to the correct question. US dollar 1 lakh and the contract size rupees 4 lakh 72,000. Many similar questions are there like this. To come to this one properly. Okay, let's do this one now. Hope you got the question. XYZ Limited is an export oriented business house based in Mumbai. The company invoices in customers' currency. Its receipt of US dollar 1 lakh is due on September 1st, 2009. Market information on June 1st, 2009 is exchange rates, currency futures. US dollar spot 1 month forward, 3 months forward, US dollar per rupees, contract size June, September, month, initial margin, interest rates in India. On September 1st, the spot rate is 0.02133, currency future rate is 0.02134. Comment which of the following methods would be most advantageous for XYZ Limited: using forward contract, using not using currency future, not hedging currency risk. Okay, first one is using forward contract. Let's do it quickly. That's much easier to do. Okay, so first forward covered. Okay, this is for an exporter. So for exporter, it would be forward sell rate. Okay, now which forward should we take? Look at the data correctly. Due on September 1st and market information is given on June 1st. So today is like a June 1st and in due date should be September 1st. So from June 1st to September 1st, what is the time period for which you have to enter into contract? June full, July full, August full, September don't take it. 1 day and all, don't worry. 3 months. And 3 months forward contract, they have given 0.02127. And how do you understand 0.02127? It is $1 equal to 1 rupee equal to. Definitely not $1 equal to. 1 rupee equals 0.02127. And here, therefore, dollar/rupees, we can understand. It is 1 rupee equal to so many dollars. So slash here we can interpret as per rupee, rupee, but not every time. Here we can 1 rupee 0.02127. So the slash don't read as per 1 rupee always. In this case, it happened good. So 0.02127 is the rate. So 1 rupee equals 0.02127. We don't have to worry about any higher rate, lower rate, only one rate is there. But we should be careful about, should I multiply or should I divide? What is the invoice amount? Invoice amount we have 1 lakh US dollars. 1 lakh US dollars, which is right hand side. So we should divide. So 1 lakh divided by 1 lakh dollars divided by 0.02127. 47 lakh 1,457 rupees. Because dollars was there, we applied conversion rate, we get rupees. 47 lakh 1,457. And this for exporter, so this will be your inflow. Inflow. Okay. Then we come to the future hedging. Hedging using futures. Same 3 steps like options. First step, number of contracts. Number of contracts. Then second step, sorry, not first step, number of contracts. First step is the type of option, like type of future. I'm sorry, type of future, future buy or future sell, type of future. Same step we follow. Then step 2, number of contracts. Like option, same steps, number of contracts. And step 3, cash flows. Cash flows. Okay. Types of future. Depends on the same steps. What is the quotation given, quote available? Depending on that, the left hand side will become the underlying asset, or you can also think based on the lot size. Lot size is easier actually. But anyway, now which one should be selected? Should I select about currency future? We are in June month. So should I select June month or should I select September month? We are in June month. If I select June future, when is it going to be expired? June future normally means June end. And in India, I told you, it is last Thursday of the month. But don't worry about it. The Thursday and all, you don't worry. When I say month future, it means it is ending on the, it is expiring on the end of the month. So June future means expiring on June end. And we are going to receive the money when? Only September. So June future is not correct. We are in June, but we don't want June. We want future, which means we want September. But one doubt, sir. You told September end is the expiry date, but September 1st is the receipt date. So should I wait for the end of the September? Should I tell my customer, hey, don't pay me now. Expiry date is end. You pay me after 1 month. No, you don't have to do. Why? Because even though expiry date may be 30th September, it will be traded on a daily basis. You can exit anytime you want. And what is it called as? What is the process of the exit in future is called as? Square off. Square off. So what do you do in futures? Today, you take one position on June 1st. In the September's futures, you take a position today. On expiry date, not expiry date, on September 1st, you square off your position with one more rate prevailing on September 1st. Prevailing on September 1st. Sir, what is that rate? We don't know. Sir, in future, we know the rate in advance. In future, there will be 2 rates. One rate is known in advance. Another rate is not known in advance. Hope you remember futures. Your entry price is known. Exit price is not known. Your exit price is known only on expiry dates or on the square off date. Till then, we don't know. Buy rate, you know. Sell rate, you don't know. Or if you sell it today, sell rate I know, buy rate I don't know. Only one rate I know. Which means when they give you problems on hedging with futures, in advance, I can't tell how much is my accurate cash flow. See, in forward hedging, I can tell you accurate cash flow. This is the rate. In money market hedging, so many transactions are there. Still, I know how much amount I'm going to get. In option hedging, I know the maximum amount for an importer, minimum amount for an exporter. How? Because I know option strike price. That is the minimum amount guaranteed for exporter. Why? Because if market is beneficial, you go to market and do it. So in options also, One layer of confusion is there, one layer of uncertainty is there, but still my minimum is guaranteed for exporter, my maximum is guaranteed for importer, not beyond that. It will not go beyond that for importer. Capping is done for importer. But in futures hedging, if you use the futures for hedging purpose, today entry rate I know, but the exit rate I don't know. Exit rate I don't know. So when I know the don't exit rate, so when will I come to know? Only on the date of square of I'll come to know. So then how can you call futures is for hedging purpose? Uncertainty is there. Going back to hedging with index futures. Hope you remember, little bit of flashback, index future. You have a portfolio long position. Normally, you take a corresponding short position. Of course, exceptions are there like negative beta, but long position portfolio on index futures, you take a short position. But risk is not same. So you multiply it by beta to make the risk equal. So portfolio amount into beta whole divided by lot size into index future price will give you number of contracts to be entered into. Then subsequent day, portfolio can have a loss, but future hedging gives you profit. But is it going to be perfect profit and loss? Perfect hedging will happen? Not always. Because in portfolio loss, what you got, in the future hedging profit, one loss, one profit you will get. But how much loss will recover? Not sure. It will recover something, but not perfectly. But how much we don't know. So future hedging is a means of mechanism. It's not a perfect hedging. It's one of the hedging technique available, but perfection or not will not come to know, and that will come to know only on the settlement date. Till then we don't know the amount. And some problem we have seen index future hedging where we have seen loss in all cases. We have X limited, A limited, and then Nifty futures. We took Nifty future to cover the risk, and all of three gave them losses. So that situation also happened. So futures, it can happen. But still, why will people use futures? For various reasons, maybe convenience. Futures hedging does not have much of cost. Option hedging means you have to pay premium today. Future hedging means you can use margin. Margin, different means are there. You can put a fixed deposit and give margin for that. Various different reasons are there. So let us not talk about if future hedging is not perfect, why do you do it? Everything is not in life is not going to be perfect. This is also one of the alternatives available. So what is the summary of all this discussion we had? Simple. If there is a problem on currency future hedging, then to compute the cash flows under currency future hedging, we need the rates on the settlement date. We need the rates, actual rates. In advance, I can't compute. So in advance, I can't say like forward money market hedging was beneficial. I can't say. So remember it very simply. Solving the currency future hedging. In fact, future hedging problems are like post-mortem problems. Only when the event have taken place, we can judge how much cash flow will take. Till then, exact amount we will not be knowing. Futures, no doubt, will provide protection. But exactly how much amount, we will not know. Exact amount, we will not know. It's not an insurance where you know the insurance premium. This is more of small agreement where if some loss happens, somebody will help you out. Exact amount we don't know. It's like this. Just an example. The money you are having in bank account. Bank goes bankrupt. Lakshmi Vilas Bank, Yes Bank, Global Trust Bank some years back. So what will happen to your money in the saving bank account? Is it gone? FD amounts? No. RBI will provide you some insurance, deposit coverage insurance is there. But how much they will cover? I don't know. Some coverage is there, but how much we don't know. So something will come back, but not 100%, maybe 100%, but not always. So future hedging means post-mortem situation. To compute the cash flows under future hedging, we need the actual rates on the settlement date. Otherwise, I cannot compute actual cash flow and I cannot comment on the most advantageous position. So repeat once more. In future hedging, we need the entry rate we know, exit rate on square of timing. We don't know the rate. So to compute the cash flow in future hedging, the actual rates must be given for you to give a comment whether it was advantageous or not. Now in this case, please check it out. Spot rate on September 1st, you see September 1st. Spot rate is so much, future rate is so much. You see future rate. So today you take a position at 0.02118. Entry rate by yourself will decide, and exit rate 0.02134. Are you clear? In case of future hedging, entry rate we know, exit rate we don't know, and that should be given in the problem. Then only effective cash flows can be calculated. In this case, our entry rate will be 0.02118. Our exit rate, our square of rate is 0.02134. Sir, buying or selling? We'll come to it. We have to discuss that. Okay, very good. Hope you got it. Okay, let's go back to the basic quotation. Quotation entry rate 0.02118. So 1 rupee equals dollars 0.02118. 1 rupee equals 0.02118. Okay, then what is the underlying asset is going to be? You can again think like the options. You can say left hand side in the quotation, or you can look at the lot size. What is the lot size? Rupees 4,72,000. Please observe forwards, no lot size. But in options future, there will be lot size. 4,72,000. So what is going to be underlying asset? Underlying asset is rupees, INR. Why? Because lot size is in rupees 4,72,000, or left hand side in the quotation, in the rate, left hand side in the rate, in the future rate, in the quote, left hand side in quote. Okay. Then underlying asset is done. What is the requirement? Requirement. You are talking about an Indian exporter. Indian exporter will be selling goods, and he will receive USD from his customer. And in the market and in the futures, in the future forward options, money market, wherever, in the future market, he has to get rid of USD and get rupees. And get rupees. So USD is selling and rupee is purchasing. Getting means purchasing, right? USD is sold, rupee is purchased. But we should think from underlying asset point of view. What is the underlying asset position? The underlying asset is rupees. Now, with respect to rupees, what we are doing? Underlying asset contract size rupees 4,72,000. From rupee point of view, we are purchasing. So requirement is purchasing rupees. getting rupees from underlying asset point of view. So purchasing rupees means what is the type of option or type of future here? You are getting means buying. So future buy. So rupee means you would have purchased. If it was USD, you would have sold. If underlying asset was US dollar, it would have been future sell. Thinking from underlying asset point of view. I hope you are able to understand what is happening. Future buy. Because rupee you are buying, you are getting, you're receiving. You have to receive by selling dollars. Or the shortcut what I use in option, that also repeat for your reference. The shortcut option, hope you remember the type of future if you want to select. Two situations. Remember, what are the two situations? The shortcut one, two situations. Invoice, currency, and the underlying asset, currency are same. Another one, invoice, currency, and underlying asset currency are not same, different. And there two positions can happen for exporter, for importer. Here also for exporter, for importer. When the positions are same, you do regular stuff. Regular contract. When it is not same, you do opposite. Okay. Now exporter, what he would do normally, he will enter into forward sell. An importer would do normally forward buy. When it is opposite, what exporter should do? Reverse. Means he should do forward. I mean, not forward. I'm sorry. Not forward. Future. Future. Not forward. Future. So exporter normally would do future sell. Importer normally would do future buy. And exporter now when opposite is there, normally he would do future sell. Now he has to do future buy. And in importer, normally you do future buy, and here you do future sell. In this chart also you can remember whichever is comfortable, you do it. In this problem, what is the invoice amount? $1 lakh, right? Invoice amount $1 lakh. Invoice is in dollars. What is the underlying assets? Lot size rupees. Underlying asset rupees 4,72 is the lot size. So currencies are different or same? Currencies are different, not same. That's why you are thinking an exporter point of view. So that's why he went opposite and went for future buy. I hope it is fine. Okay. Hope you're taking the chart also very similar to the options one. There also, when they are different opposites, here also when they are different opposites. So if you do options hedging, future hedging parallelly, you will get more confidence on both the cases. If you do distantly, you may not be able to remember the connection. Anyway, let's go forward on this one. Okay. Number of contracts. Same rule. Remember number of contracts what we did? The formula there was invoice amounts divided by lot size. Same thing like in for options, but when the invoice amount and the currency, the underlying assets are different, what we used to do, the invoice amount should be converted into the underlying asset. How do we used to do? We used to divide by strike price. Here we don't divide by strike price, you divide by future rate, where your commitment rate, whatever the quotation you calculated, that we take it. Divide by the future rate, entry price. Divide by the future rate, entry rate, because they are different. If the invoice amount and underlying assets are same, this division will not come. So invoice amount is $1 lakh, divided by 0.02118, whole divided by lot size 4,72,000. Number of contracts. 10 contracts, round off. And here you don't have to worry about fractional contracts. Even in index future hedging, when we used to say round off the contract. So perfect hedging was not possible in futures anyways. So unlike in options, for the fraction you enter into forward cover, not required here. You can ignore. Because anyway in future it's not going to be perfect. So 10 contracts. Number of contracts is done. Cash flows. Cash flows today is going to be margin. But margin is not your expense. So 3 types of cash flow will happen. Hope you remember the 3 markets in futures, hedging or everywhere we discuss 3 markets, which is there in the subject name, SFM. In spot market, in money market, and in future market. In future market, in spot market, and then in money market. Okay, in spot market, what is the transactions you're doing? You are, whatever the dollar you receive from customer, selling the spot. Selling in spot. Because in futures, we are keeping separately, because future rates are also available. So spot market we are keeping separate, future market we are keeping separate. So whatever the dollars you receive from your customer, sell in the spot. In future, you are squaring off your position. Square off your earlier position. You enter into future buy, right? Inception, number of contracts, 10 contracts you entered, you need to square off. In money market, you margin you deposit earlier, now margin will come back, so you have to pay interest on margin. Margin will go, margin will come. Deposit go, deposit comes. But what you lost is the time value, either interest or opportunity cost. So interest on margin. Interest on margin. So what are those amounts? Okay, now spot rate. Now these are all, I mean, cash flows on September 1st. Only that we know. On September 1st only we know. Spot rate. What is the spot rate on September 1st? They should give. Otherwise we can't solve this problem. They have given, see, on September 1st, spot rate is 0.02133. 0.02133. Again, sorry, we should multiply or divide. This is 1 rupee equals to so much of dollars. So this 0.02133 is right hand side USD. $1 lakh right hand side, rupee left hand side. 1 rupee equal to so much dollars, dollar right hand side. Right hand side means we should divide. So 1 lakh divided by 0.02133. 0.02133. $46.88,232 rupees, because dollar is there. Applying conversion rate, we get this 46.88. $232. Okay, square off. Earlier you did future buy. Now what you are going to do for square of? You are going to do future sell. So square of formula will be future sell minus future buy. Difference between sell rate buy rate multiplied by the number of contracts lot size, like in options. Number of contracts and lot size. What is the future sell rate is going to be? They have given 0.02134. 0.02134. Why it's sell? Because earlier I bought. If earlier was a sell, then today I would have earlier was sell, today I would have bought. So earlier I bought, now I sell. Opposite, future sell minus future buy. 0.02134 minus original rate quotation 0.02118 into number of contracts 10 into lot size rupees 4,72,000. How much I get? 0.02134 minus 0.02118 into 10 into 4,72,000. 755.2. Is this rupees or dollars? Is this rupees or dollars? Simple one only. Please observe, we are having rupees 4,72,000. Then multiplying by this conversion rate. Strike price is like conversion rate. Premium is like conversion rate. The future price is also like conversion rate. So conversion rate applied on rupees 4,72,000. Other currency should come. Therefore, it is dollars. It is dollars. Now I can't express the answer in dollars. I have to convert it into rupees because we are thinking from Indian point of view. So one extra step will come. Is it buy rate or sell rate? This is the profit. So you have to sell it. If it is a loss, you would have purchased. So it's you receive so much. Since it's a profit, you can sell it off. Sell rate. So multiplied by spot sell rate. And spot sell rate not on June 1st, September 1st on expiry. Only then you know this amount. And spot rate you know 0.02133. Use that only. So 1 divided by 0.02133. At that rate only you exit. 755.2 into 1 by 0.02133. 35,405 rupees. 35,405. Profit. So inflow. 35,405. And logically, why are you making a profits? In this case, you see, it was 0.02133. And when you entered 0.02118 and became 0.02134. So rates have increased. You have taken a buy position. So when you take a long position, when the rates increases, you make profit. You make profit. On the other hand, if rupee is appreciating, what is happened to dollars? I don't want percentage. Can you think conceptually? Rupee is 0.02118 became 0.02114. It means rupee appreciated means dollar depreciated. Dollar depreciated. Now, exporter is having an asset in foreign currency, receivable, customer receivable, trade receivable, and that means asset in foreign currency dollars. When asset depreciates, what would have happened? He would have faced loss, right? In your accounting terms, he booked it at one rate, now it is down. You would have entered a loss on conversion, but that loss will be compensated by this profit. That is how this is helping you covering your losses. It's not visible directly, but it is covering your losses. But anyway, Now, money market, interest on margin we have to pay. Interest on margin. Which margin we should select? September margin, because September future is what you are going to enter into 15,000, and normally this 8% means we apply for per annum basis. So multiplied by number of months, 15,000. Okay, remember one more thing I forgot. This is per contract. This information is per contract. Per one contract. You enter into 10 contracts, so you should multiply by that. So 15,000 into 10 contracts into what is the rate of interest? 8% for 3 months. 15,000 into 10 into 0.08 into 3 by 12. 3,000. 3,000. Okay. So what is the effective inflow? This is exporter effective inflow. Uh, 4688. This is inflow. 35,405 is inflow because profit, but 3,000 is outflow. Interest on margin is always an expense, outflow. So 4688 232 is inflow. 35,405 is inflow because profit, if it is loss, outflow, minus 3,000 expense. 4688 232 plus 35,405 minus 3,000. 4720 637. 4720 637. Okay. Now this is future hedging. They ask one more, unhedged, no hedging. If it is unhedged, how much would be the amount? Unhedged. Very simple. Unhedged means you would have got only in spot market, right? Only spot market amount would have come. Unhedged situation, which is 4688 232. 4688 232. Okay. Now, which is the best one now? 4688 232 or 4720 or future hedging how much? 4701. So which is the highest cash inflow for exporter? 4720 637. So based on this we can say future hedging is most advantageous. Future hedging is most advantageous. Future hedging is most advantageous. But one point is, this we cannot make a comment in advance. This we can make a comment only when we complete the transaction. That is why I told you future hedging problems are like post-mortem problems. So the question has to specify on the settlement date what is the spot rate, what is the future rate. So in spot market rate I can take it, in future market rate I can take it, I can tell you overall cash inflow. So once the event happens only we can compute and we can make a comment. Margin outflow will happen, but margin inflow also will happen. No, margin is like a deposit. You deposit margin and it will come. So inflow outflow, you don't lost, but what you have lost is the time value of money. That is why I have considered interest on margin. That is your expense. So margin, outflow, inflow will set off each other like a working capital. It goes in, it comes back. It does not have any impact overall profitability wise. Profitability wise, the opportunity cost, the time value of money. Because to deposit, you would have borrowed the money or your opportunity cost. That is your expense, which we have subtracted 3,000. Okay. Hope you got this one. Okay, so moving on to this variety now, on this Nostro problem. Only one variety problem. Many problems are there, but only one variety is there of the same kind. Let's do this problem along with we'll understand the concept. You as a dealer in the foreign exchange have the following position in Swiss francs on 31st October 2004. Balance in Nostro account, opening position overbought, purchased a bill on Zurich, sold a forward TT, forward purchase contract cancelled, remitted by TT, draft and Zurich cancelled. What steps would you take if you are required to maintain a credit balance of Swiss francs of 30,000 in Nostro account and keep as an overbought position on Swiss francs 10,000? Let me quickly tell you the meaning of this Nostro account, and one more term is there, Vostro, and also one more Noro. Problem will be only a Nostro, but quickly I'll tell you the three varieties of accounts you can have. Nostro, Vostro, and Loro account. Nostro account means uh, Indian having accounts, bank account basically, let's say bank accounts in foreign currency terms. In foreign currency terms. So for example, let's say SBI or any dealer goes to US and opens an account with Citibank. Like for example, when SBI wants US dollars, where they get it from? They can purchase from the market. Or if they have their own dollar account, they can easily use that money, transfer it, and then pay it off. So, and an Indian person having a bank account in foreign currency terms, Indian person or Indian bank itself, like SBI having a branch in New York with Citibank, that's called as Nostro account. And this is called as our account with you. Our account with you. Vostro is opposite, that is a foreign person or bank, foreign person or entity having bank account or having account in rupee terms, in local currency terms, in rupee terms. So it's called their account with us. Their account with us. So just like we need US dollars, US banks also might need rupees. When the transactions might take place in rupees, though they also need rupees. So they need to buy rupees, so they can maintain one account in rupee terms itself. Like Citibank maintains one rupee account with SBI, their account with us. In fact, Nostro, Vostro are two sides of same coin. For us, it's Nostro account. For them, it's Vostro. Just like home currency, foreign currency. It's all the person's point of view. So for us, US dollar is a home currency, foreign currency. For US person, US dollar is a home currency, local currency, right? So it's all two sides of same coin. So similarly, Nostro is for one person. Other point of view, the same account looks like Vostro. So, but basically, Nostro account means maintaining foreign currency bank accounts. When a person transacts in foreign currency, maintains the transactions in bank account in foreign currency, that is Nostro. Loro is maintaining third party bank account. Maintaining third party. Third party. Uh, third party for foreign currency account. What is third party currency account? We say it is their account with them. their account with them. In the sense, if SBI, I mean, if an Indian person want to have an account in, let's say, Pakistan, you know, you will not be able to have a direct account. You will not be able to do. So you will open an account with US in New York, US dollar, and US will open an account with Pakistan through a third party. So intermediary. So whenever you want to transact, you don't transact directly. You don't have a bank account in Pakistan, but you will have it through an intermediary bank. That's called as Loro account. That's only theory purpose. Don't worry much. Problem will not come. Okay. Now, with respect to this problem, let's focus on this problem now. On this, they said Nostro account and overbought position. Okay, this Nostro account is like a cash position, I will say. Basically, bank account when you maintain a bank account. So, dealer maintaining a bank account. Dealer having an account with bank. So, in this case, when they say Nostro account, because they're talking about dealer, let's write that. Nostro account here means the dealer maintaining account with bank. This is like foreign currency cash in equivalent. So dealer maintaining account with bank, that is Nostro account. So you will have foreign currency cash. Foreign currency cash position. I mean, when I say cash position, please understand cash and cash equivalent. We say cash, bank balance, both are equal. In that sense, cash position you are having readily available. Then you are having one more, which is overbought position. Position. This includes, interesting point. Let me write first. This includes the cash position, that is the Nostro account, and forward position. Include forward position. Let me just give an example here. Suppose you purchase, a dealer purchased, in this case, let's say Swiss franc, 1000 Swiss franc. So you will have bank balance Swiss franc, right? You will have bank balance, I mean purchase Swiss franc. So in your bank account, Swiss franc will show 1000. This is one situation. Now you think of, you enter into a contract to buy, forward buy. Let's say another 1000 Swiss franc. Now, will this 1000 come to you into the cash today? This is a forward buy transaction. Now, forward buy transaction, a dealer, when he executes, then only he gets. So, this 1000 Swiss franc will not get added to the bank account immediately. But he has to maintain a record for this. That's what we call it as a exchange position. Exchange position. So Nostro account will only talk about the cash in hand, that is bank balance maintained. Whereas the exchange position means it's a combination of the bank balance as well as the Nostro account. I hope you're able, the forward contract as well as the cash position. I hope you got the overall point. Let me just tell you once more. We have to maintain two ledgers now. One is the exchange position, which is more like a register, and this comprises of overall what amount you have in terms of foreign currency terms, which is the contracts in hand plus cash in hand, plus cash positions. Cash in hand means that cash equivalents, cash in hand plus bank balance, contracts in hand plus cash position that is readily available. So contracts on hand means you're going to get it. Cash position means you are going to execute it. I mean, you're having it. So contracts in hand means you are going to execute. So what you have with you in cash or bank, that is cash position, and what you're going to get is contracts in hand. Together, it's called as exchange position. Whereas nostro account is like a cash position where we maintain only passbook. It's like passbook entry. Your bank balance, bank statement is your nostro account. So nostro account is the cash position of foreign currency. Exchange position is combination of the cash position plus the contracts in hand. What you have plus what you're going to get is called as exchange position. What you have is called as nostro account, cash position. It will reflect like a passbook, bank statement. So exchange position will have a format like purchase, selling, balance, etc. But anyway, any doubts? Did you get the overall concept of nostro account? It's a foreign currency account. I have not saved anything. I've taken out everything. So everything is erased. So nothing to go back. So nostro account means it's a foreign currency account, and they give you problems and say prepare the nostro account and exchange position. It means a nostro account we only take the transactions in cash, and in exchange position it should reflect the contracts plus the cash movements. So exchange position is equal to contracts in hand plus cash position, whereas the nostro account only reflect the cash position. It is like a bank passbook. Okay, so let's write down. So we have exchange position, and we have the nostro account. Nostro accounts is a cash position which is actually like a bank passbook. It reflects a bank passbook, bank statement. It's a bank statement. Remember, we are doing for dealer. We are not doing for the bank. It's a bank statement. Now, exchange position is a cash position plus contracts. Cash positions plus contracts. And this is more like a register. This is not an account. This is more like a register because contracts in hand. Contracts are not taken in books of accounts. So more like a register. Okay. So what we are going to have an exchange position. We are buying something, buying contracts, buying something, selling something, and balance net. And here we don't say buying and selling. Like your bank passbook, how will you have credit transactions, debit transactions, net balance. Okay, now they said balance in nostro accounts. Balance in nostro account, credit balance 1 lakh. Credit balance means what? Hope you understand how the bank statement look like. Hope you have seen some bank statements in your life or the passbook. When you open a passbook, it will have a credit balance. That means you have a balance with the bank. So 1 lakh balance in nostro account. So we can show opening balance. Or you can write debit first, credit later. That's also fine. I think let's do that. Let me write debit first, credit later. That's how the actual format looks like. Okay. Opening balance. Balance in nostro account 1 lakh. Balance. Let me write in the balance side. 1 lakh. Opening position overbought 50,000. So here also opening balance 50,000. And here it is credit balance, net balance, and here overbought. That means net buy. That's what they overbought means. They meant net buy. So considering the contracts in hand and cash in hand together, they have a 50,000 Swiss franc with them. Oh, okay. Then we have opening position overbought is done. Okay. Purchase the bill on Zurich. I mean, you have to understand Zurich means it is in France. So it's about the France currency, but okay. Purchase the bill on Zurich. So purchase the bill, does it mean cash transaction or only is it forward transaction? Purchase the bill does not mean you have purchased in currency terms. It's not in cash transaction. It's a bill. It's a contract. Purchased a contract. Purchase the bill. It's like you entered into a forward buy contract. And forward buy contract means it comes only in the exchange position, not in the nostro account. So purchase the bill, it will come only in the it's a contract. It's not a cash transaction. It will not come in nostro account. So purchase the bill. On Zurich, 80,000. That's a buying 80,000. So you already had buy 50,000. Now 50,000 plus 80,000, buy becomes 1,30,000. Net buy position balance. You don't have to calculate one by one, but I'm doing it for my reference. Okay. So opening balance is done. Then purchase the bill on Zurich is done. Sold forward TT. TT means telegraphic transfer or telephone transfer. Earlier it used to happen through telephone. Now everything is like Swift code, everything online. But TT means a mode of communication. Beyond that, don't worry. It's a transfer mode of communication. Telephone transfer, telegraphic transfer. Sold forward TT 60,000. Name itself is very, very clear. Sold forward TT. Which means here we are going to do on the exchange position only. It will not come in cash position. It's a forward transaction. Sold. Forward. TT. Sold. Therefore, it will come under selling. 60,000. 60,000. So 1,30,000 your buy position. Sold 60. So balance becomes 70,000. 70,000. Net buy. Net buy position 70,000. Okay. Forward purchase contract cancelled. Forward purchase contract cancelled. So it's a forward contract, meaning when you enter into the forward contract, it came only in exchange position. It did not come in nostro account. Now when you cancel also, it will not come in nostro account. It will come only in exchange position. And how it came earlier, now it will be opposite. How it came earlier, it was forward contract purchased earlier, some earlier time. It would have come in buy column. Now you're cancelling, it will come in opposite column. So write in sale column. So forward contract cancelled. Forward contract cancelled. Forward contract cancel. It's like a purchase return. It will come in sales column 30,000. So we thought opening balance we had 50,000 net buy. We thought 30,000 would be buying. Now contract cancelled. So that balance will reduce. So 70,000 net buy was there. Minus 30,000 means now you are having only 40,000 net buy. Okay. So this also done. Now remitted by TT. Remitted. It's a cash transaction. Remitted by TT. Given. It's going out of your hand, which means where it will come? It will come in exchange position also. It will come in nostro account also. Why it will come in nostro account? You are remitting, you are paying. So cash balance is definitely reducing. So your bank balance will reduce. Your nostro account will reduce to be debited like a bank statement. You withdraw money, you make a payment to some people, your bank balance will reduce. Issue a check, right? Now, similarly, the exchange position also will be affected because in the exchange position, what is exchange position? Cash position plus forward contracts. So, whether there is a cash position, exchange position ledger will be affected, register, or if there is a exchange forward contract, then also it will be affected. So, both cases, the exchange position need to be given impact. So, remitted by TT, 75,000. So, we have to give the effect in both the places. So all the cash transactions will come in both. But forward contracts comes only in exchange position. Okay, so nostro accounts. Here we will have what we told, remitted by TT. Remitted by TT. It will have a debit balance, 75,000. Okay, I wrote down again credit debit. Okay, should write debit first, credit later. But it does not matter. $75,000. So 75,000 if I debit, net balance will now be only 25,000. Debit balance. In fact, you don't have to show net balance for every transactions. I do it for clarity purpose. You can do buying and selling one column and debit credit one column. You don't have to do the net balance column for every transaction. But that's what bank statement look like, right? So I'm writing like this. Okay. So this is done. Draft on Zurich cancelled. Draft on Zurich cancelled. It's a credit balance, correct. Sorry. It's a credit balance. You're right. 1 lakh was there. 75,000 we debited. Net credit balance will continue. Correct. Okay. Now, draft on Zurich cancel. This might be slightly technical term. You should understand. Very simple only. Draft is like the forward contract given. I don't know whether you handle DD draft much in practical life. You had given a draft. You had given a draft. You had issued a draft. Draft on Zurich on foreign currency. You had given a draft. That is like a forward sale contract. Now cancelled. So draft on Zurich cancel, you treat like a forward sale. It's a draft. It's not yet a balance. It's not come to your bank balance yet. So it's a forward sale contract, draft, but cancelled. Forward sale cancelled. So draft, you remember, like a forward sale cancelled. It's like a forward sale cancelled. You had given, but it cancelled. So it's like a forward sale cancel. So it will come only in the exchange position. Draft on Zurich cancelled. 30,000 will come in the buying section. It will not affect both the accounts. As I told you, it's a forward contract cancelled. It's not cash paid. It is just a draft given. So it is not gone out. Earlier 75,000 comes in both. Oh, correct. Oh, sorry, you're right. Earlier 75,000 it should come. Correct. I missed it. You're right. I missed it. The 75,000 should come in both the places. This 75,000 should come in both the places. That should come. I missed it. I'll write now. That should come in both the places. You're right. The 75,000 should come here also. I missed it. So I'll write below this. The 75,000 was below this transaction. Yeah. That should come in both the places. Yes. I'll just write this one. You're right. Thank you for identifying. Would have taken later, but anyway. Remitted by TT will come in both the places. Remitted by TT. Sold means selling 75,000. So what about the net amount? Yes, it will be 35,000. 40,000 net buy was there. 75,000 you sold. So it becomes 35,000 net sales. And this draft on Zurich cancel, again 30,000 will come only on the exchange position. Draft on Zurich cancelled. That is like a sale transaction reverse, forward sale transaction reverse. It's like a sales returns that will come in buying. Sales returns 30,000. So 35,000 net sales was there, minus 30,000. So you will have 5,000 net sales. You have sold more than what you have net sales. And does not make difference sold forward TT. Now forward TT will come only in exchange position. But sold TT, remitted by TT, sold TT, remitted TT, both are same. Sold TT, remitted TT, both will the things will come in both the places. Sold forward TT will come only in exchange position. Sold TT, that means remitted TT, sold TT, remitted TT, both are same. As I told you, remittance sold, both are same. Both are going out, both are payments, both are going out. So in that case, it will come in exchange position as well as it will come in cash position. I hope you are clear till all the transactions here. How the balance is 35,000. Okay, let me show you the balance from beginning. 50,000 was there. You added 80,000. So it became 1,30,000. Out of 1,30,000, you sold 60. That means 70. Out of 70, you sold 30. Effect of sales 30. It became 40. Out of 40, you sold 75. You had only 40. So 40 minus 75 becomes minus 35. That minus 35, I'm calling it as net sales. Net sales. And minus 35 plus 30,000 becomes 5,000. You can understand like that. Or you can also say 35,000 net sales was there and we have a buying of 30,000, sales 35,000, buying 30,000, net amount sales 5,000. Won't the cash flow from purchase or sale of bill affect notes to account? No. Purchase or sale of bill is not a cash. It is a contract. Only when the bill executed. Bills, bills of exchange and all you would have learnt. Only when the bills is executed, settled, then only the cash balance will come. Till then, it will be BR, bills payable only. It will not come to the cash balance. A bill is not a cash. Purchased a bill means you just got a, it is just that. Draft on Zurich cancelled is like a, for what was the, you have issued draft earlier, now it's cancelled. You have given drafts. So earlier you sold forward contract, now it got cancelled. So it is a forward sale contract cancelled. Therefore, it is purchase returns. Sales returns. Sales return means it will come in purchase column. It's a sales return. It's a sales return kind of thing. When the forward TT is sold, don't there be margin cash flow? No, margin will come in futures, not in forwards. Margin don't come in forwards. Margins are there only in futures. Okay, fine. So this is the transactions we have given the effect. I hope your doubts are clarified. Now, what steps you take if you are required to maintain a credit balance of Swiss account, 30,000 in Nostro account. Please look at the balance now. How much we are having in Nostro account bank balance? Only 25,000. But how much we need? 30,000. We have 25. We need 30, which means we need to buy in the spot market. So we need to buy in the spot market. How much? 5,000. So here we say TT purchase. We additionally get the amount and we deposit it. TT purchase 30,000 minus 25,000. We have a 25,000 balance, but we want a 30,000 balance. So 5,000 extra. So 5,000 we create it. And it becomes 30,000. Our balance of 30,000 is achieved. But you know what is that impact? This what you purchased in cash position will also influence exchange position, because in exchange position it is cash position plus contracts. So there we write TT purchase. TT purchase means spot purchase. TT purchase, spot purchase 5,000. Spot purchase 5,000. So 5,000 net sales was there. Now we purchased 5. So how much it becomes balance? Net sales, and this is buying. Net sales is like minus. Buying like plus. So minus 5,000 plus 5,000, it becomes 0. And what the position they want to have in the overbought position? They want to have overbought position of 10,000. Overbought position means they want to have a net buy. So here from 0, they want to reach 10,000. So you enter into one forward buy contracts. Forward buy contract. Forward buy contract. How much ever you want. You want to have a position 0, everything is settled actually. So you want to have a 10,000. Okay, forward buy contract 10,000. 10,000 you do forward buy. So balance becomes 10,000, which is your net buy. Net buy. TT purchase how? We are having a Nostro account balance of 25,000 as of now. But in the problem they said they want to maintain a balance of 30,000. So 30,000 minus 25. I showed you the calculation also of 5,000. And that 5,000, because you're doing cash transaction, will also come in exchange position. So exchange position is a record for the cash transaction as well as forward transaction. Both should come there. Since you're purchasing 5,000, it will come in the Nostro account, because difference between 30 minus 25, it will also come in exchange position. Remitted by TT means we have received a payment. Correct. Remitted by TT means we have remitted. We have given. We have not received a payment. We have given. We have remitted. Means it's going out. As a dealer, you remitted Swiss franc to others. So your Swiss franc balance will come down. We are only talking about Swiss franc balance. We are not talking about rupee. When you remit Swiss franc, you get rupees. We are not talking about that. It's like what comes in Swiss franc, what goes in Swiss franc. Only think like a product. Think like a product. So you are remitting Swiss franc means from your side, Swiss franc is going out. So it is a selling column and it is going to be a debit item in the cash position. And when you transact cash, it is a cash, and exchange position has cash plus contract. Contract is not involved. That's what I told. All the transactions will affect exchange position. That's what I told. Cash position plus contracts. Heading only I have given. Cash positions plus contracts. Cash position plus contracts. Cash position plus contracts. Heading I have given. Cash position plus contract. Whereas nostro account is only cash position. So all the transactions will affect exchange position. Correct. I can't say all the transactions blindly, because what if we execute the forward contract? Will that come in the exchange position? When you execute the forward contract, it will not come in exchange position, because already you have written when the contract is entered into. Now you execute, get the amount, it will not come in exchange position. It was already there. It will come only in nostro account. So blindly I can't say everything will come. But transactions of cash position and transactions of contracts both will appear in exchange position. Both should appear. But blindly I can't say all the transactions, whatever line item will come here. Not necessarily. When you execute a forward buy, forward sell, it will not come again in exchange position. Because when you enter the contract only, you entered it. Again, when you execute, it will not come in exchange position. It will come only in the nostro account. Upon the execution, we cancel off. Why should we cancel the contract? The exchange position is not just a contract. It's contract plus cash. You cancel in the contract and you get in the cash. Why double cash, double entry? It's cash position plus contract. When you execute the contract gets reduced, cash position gets increased. So exchange position won't be affected. It's cash position plus contract. When you execute the contracts, we need when you receive or when you not when you receive. Don't tell me when you receive. When you execute the forward contract, either buy or sell, that need not come in exchange position, because it is already there when you enter into the contract. But if you buy in the spot, if you sell in the spot, that comes. Okay, so exchange position is cash transaction plus contracts, and nostro account is only cash position like a bank account. So if at all a problem comes in exam, this is the variety it comes. So remember all these terminologies, all these transactions, only this one will come. No other complications can come if at all it comes in exam. Okay, so that's all for this problem. Let's move on now.